Okay, so we talked about debt. The second way is equity financing. Um, and the simplest way, of course, is using retained earning. Retained earnings are the accumulated profits that you have in the company, and the company can use those earnings to do their financing. If the company needs more money, it can then issue stock. It can sell a portion of itself to the current owners or to outside owners. And this money coming in is equity, and it represents the ownership in the business. And again, dividend policy. Some companies issue dividends in terms of cash or in terms of you can have stock dividends as well. Or you keep this money in so it's reinvested in the firm. And this is a policy of the company. Small, medium-sized enterprises, of course, are going to retain this money so they can grow. Larger companies may not need that much cash to continue their operations, and so they may issue it in dividends. And people, investors, may buy stock based upon the dividends and the yield that they may bring. As I said, the factors that might affect dividend policy: shareholders' expectations, because some shareholders buy with the expectation that they're going to get dividends, and then the firm's financing needs. If the firm, small, medium-sized enterprises that want to grow relatively rapidly, they may reinvest that money. Issuing stock. Okay. Common stock, preferred stock. Now we've talked about this in another lecture, but common stock represents, again, partial ownership in a particular firm. Okay, and preferred stock as well represents partial ownership in the firm, but also has some preferred or special rights over common stock. To make things simple, we're generally, when we talk about stock, we're talking about common stock. When a business sometimes needs equity funding, and but not enough to engage in a full-blown public stock offering, which we'll talk soon. Sometimes companies will go to venture capitalists, and venture capitalists invest in various businesses with expectations of very high return. And we can talk about this, and we will talk about this more in class. But just keep in mind that venture capitalists provide equity, and it's an alternative to going public oftentimes. Venture capitalists are composed of not necessarily individuals, but of entities, individual entities that invest in small businesses. Generally, venture capital firms today are limited partnerships run by a small management team, and they manage a pool of investors' money that come from the same places that we talked about that provide debt equity, but investment companies, finance companies, insurance companies, pension funds, university portfolios. Very large investors often put a portion of their money in sort of high risk investments, and venture capital is seen as high risk. So they have the chance to benefit from the success of small, medium-sized enterprises as well. Alternatively, you can go public with an IPO, initial public offering, and this is when you issue stock to the public, usually through intermediaries like investment bankers. We'll talk about that in a second. But there are lots of regulations and rules around this, but it is a way in which you can increase your liquidity, get your market value. You can get your market value up because now you are on an exchange. More people are evaluating what you are doing, and you can get more publicity. And there's a whole bunch of reasons why you may want to go public. On the other hand, there are lots of reasons why you might not want to go public because of these regulations, because of a lack of privacy, because the fact that you are reducing your percentage ownership, and that entails additional risk and that sort of thing. And we can talk about that. However, when you start a firm, especially in the U.S. and oftentimes in Europe, going public is what you really want to do because that really is a way that you can exit. It's also a way in which you can significantly increase your net worth. So, how does a firm issue these securities to the public? As we said, through a public offering. And basically, it is underwritten by a group of underwriters, also called investment bankers. So, being underwritten, okay, the bank guarantees a price to the issuing firm, no matter what price the stocks are sold for. So, what will happen is the investment bankers will say, okay, your stock is worth $10. And we will give you $10 for the million shares that you're going to offer. And then they're going to try to sell it. They're going to try to sell it for 11 or 12. Okay? But even if they sell it at 9, you're guaranteed to get the 10 that they contracted you for. Another way to go public, again, is with investment bankers, but you do a best effort. The bank doesn't guarantee the $10. It says we're going to try to do $10, but we might not. And so depending upon what is the actual price they're able to sell it on that morning, okay, that's going to have an impact on how much money you're actually going to get. Now, a best effort offering is one, of course, that is a little bit easier for companies to get, but that you really don't want to do that unless you absolutely have to. You'd rather have a guaranteed price by firms that have underwritten, because a best effort is very, very risky to do. Underwriting syndicate is that oftentimes, especially in larger offerings, it is too risky and difficult for one company to do the distribution, so they form a syndicate or a group of underwriters that do it together. Another way to obtain funds is through factoring. Okay? Now, factoring is related to asset-based lending. What a factor does is a factor buys your accounts receivable. So you've sold $100 worth of goods on a 30-day credit. So you're not going to get that money for 30 days. So what a factor will do is we'll buy those receivables and give you $97 today. And, having 97 today instead of waiting for 30 days for 100 is often very attractive. Now, why does the factor do it? Well, the factor does it because he's buying $100 worth of receivables for 97, so he's getting $3 for those 30 days, which is 36% return on his money, which of course is a tremendous return. So factoring is a good business. Factors sometimes, instead of buying outright, they will loan you money against your accounts receivable. Okay, and then that moves it into the debt financing sort of category. You can get financing from suppliers. Suppliers who want your business, they want you to buy their goods and services, and they want you to grow, because then you'll buy more of their goods and services. They oftentimes will offer you finance. You don't have to pay for the goods that we deliver today for 30 or 60 days. So that's another way of getting financing. And in terms of starting a small business, you need to avail yourself of all of these opportunities, and finance by sellers is one of the best. Leasing, renting an asset for a specific period. There's no reason, especially when you're a startup, that you actually have to buy your equipment, whether it be computers or tables or chairs or anything. You can lease them. And while leasing does entail monthly payments, that might be better than an upfront lump sum. Deciding your capital structure. I'm going to start a new lecture. Let's take a break right here. Let me start a new topic. See you soon.